Treasury bonds taking a bit of a break today on Monday after a very hectic week last week. We saw bond yields trade way down, wailed nearing 2.5% yield in the 10-year, and then only to see them pop back higher as equities and risk assets started to outperform on Friday after the jobs numbers. So right now we're looking at the Treasury market as kind of taking a deep breath. Now it has been 5 consecutive days since we've traded above 2.75. That was sort of the line in the sand that if we got below it, it meant that things were really going to change technically. And while they have somewhat, we really haven't seen the market fall apart yet. There's still some containment from a technical perspective. The bond market is still in buy mode, wait and see kind of a mode, but we aren't seeing the exaggerated knee jerk that we saw last Thursday and Friday where we saw yields trade way lower and then quickly back higher. So, but we are spending a lot of time below 275, more than I think anyone would have thought, given what the Fed has done with their balance sheet and with rates over the last year and a half, and the fact that we are unable to see yields move higher. And if you look at market volatility, we broke out of the range, a range that we've held for quite some time, and boom, volatility remains elevated. It's not spiking higher. It's not seeing levels out of the blue, but we are seeing levels hold in the 10-year over 4% for a sustained period. That is elevated volatility that is causing some concern. It's making options more expensive, and you're starting to get this feeling that maybe things aren't going to work as expected, or maybe aren't as in greatest shape, whether you're looking at global growth, whether you're looking at Brexit, whether you're looking at what's going on in Washington these days. So there's a lot of things going on. Volatility remains elevated as we are outside of the range. And lastly, I think a lot of this move that we've seen once we got below 280 has been short covering. Now, short covering is something that we read in the tea leaves, whether it's through the CFTC or the TFF data, but that's something we haven't had since the government shutdown. So we really don't have any updated information since December 18th. But I can tell you this, the way the market moves when it hits those knee-jerk reactions and we see the market move very quickly in one direction and then slowly back the other, it typically suggests that we saw a nice round of short covering. And I think that could continue if we start to see yields push lower. 5 days below 275, if we see it maybe go to 6 or 10, you're going to see more of those shorts looks to cover, because the idea here isn't that we're not going back to 3%. It's just they don't know when. And holding on to shorts that long really doesn't make sense, especially if you're fearing a move back to 2.5% in yield in 10-year.